Welcome to TheoTrade. This is Don Kaufman. You're watching the Theo video for December 22nd, 2015. Ladies and gentlemen, well, I'm not even waiting until the market closes over here because it's boring out there. I can't watch anymore. I can't take it. The S&Ps right now are up 12 on what? Yeah, no volume out there. It has been a rather slow day. And when I say no volume, well, you know, we're under 1 million contracts right now throughout the trading day, and we've still got an hour to go to the close. But nevertheless, we're at 866,000 contracts. Come on! I've traded more than that in a day. Okay, that's not true. But it's still extremely light volume considering last week we were cracking 2 million contracts at this time of the day. So here we are coming into the holiday season, which is it's kind of like a time of year. And I've been doing this now since 1998. Yeah, I used to be a spring chicken, but that ship has sailed. I'm going to be 40 in 2016. I think my warranty expires at 40 years old. Some of you are probably listening to this and thinking, wow, that was 35 years ago for me. My warranty has long since expired. Nevertheless, let's get back into the markets over here. A couple of things that I want to point out, keep you up to date on, and then we're just, going to go into a variety of different topics over here. First, so in this kind of light volume, okay, what you're going to expect is you're going to expect some chop trade. And what chop trade basically means, it's very, very unpredictable, because what you get in chop trade in light volume is low liquidity. And when you get low liquidity, and I'm going to try to point this out using the futures contracts, if you trade futures contracts, great. If you don't, it's neither here nor there. I mean, this example, really should resonate with any products you trade. This is a prime, area to discuss it. So out of the blue, we're trading a couple thousand contracts every few minutes. All of a sudden, 7,000 contracts trade, and that really moves markets. So in low volume, light liquidity days, there's not a ton of market participants on both sides. So there's not a huge number of buyers, not a huge number of sellers. So somebody comes in heavy-handed, and it can really move markets, which what that really does in this kind of, this last portion of the trading year, if you even want to call it that, it creates very often markets that are completely unpredictable. And if you're looking at his grind to the upside over here and you're like, wow, I'm surprised we're grinding to the upside. I mean, today, listen, we have the bonds down almost a full point. Not surprising to see the markets grinding to the upside. But as you look down the list over here, you don't see too many big name stocks that are hot. That's because I don't have a lot of the energy sector represented here. And that, ladies and gentlemen, is what is moving markets today. It happens to be the energy sector. And look no further than if you go on thinkorswim to Market Watch, okay, Index Watch, and go to S&P sectors, you'll actually see the energy sector. Yes, the materials sector is stronger, but the materials sector is like a little peanut in comparison to the energy sector. But it's energy that's relatively strong today. What you should be focused on is what's not very strong today, and that happens to be IT, because IT, it's the 800-pound gorilla in the room, and it continues to be the 800-pound gorilla in the room. And there are 4 to 5 stocks that I will continuously focus on. And it's not just going to be the next couple of weeks. I've been focusing on this stuff for the last month. I'm going to be focusing on this stuff throughout January and February, the stocks that you need to watch, okay, that have supported the S&P 500 year to date are Facebook, Netflix, Google, Amazon, okay? And when you start to see a day where, I mean, these things are they up? Kinda. I mean, Amazon is lagging on the day, down 0.2%. It's nothing really to speak of. But Google, waffling, okay? Same with Netflix, completely waffling. It's off its lows of the session, but, down 0.2%. But these are your titans that are ultimately driving the entire S&P 500 to the upside. I mean, you look at something like Amazon, over 100% returns, year to date. And again, I just can't stress this enough times that individual stocks can, in fact, drive indices. And, when you get an underlying with the market cap of an Amazon at 114% return year to date, okay, you have to pay attention to that stock, because when they start to break down, they're going to suck the market along with it. The other area that really has grabbed my attention lately, and I'm going to continue to focus on, happens to be financials. Now, I'm into financials. My single largest position personally is in the financials, and I'm short the financials. Now, that surprises a lot of people, but yeah, no, I'm short the financials and have been for some time. And you say to me, like, you're crazy. Why do you be short the financials? Interest rates are likely to go up over here. And when interest rates go up, that would be good for the financials. Okay? Interest rates going up could possibly be good for the financials. But again, when you say good for the financials, are you talking about on a fundamental level? Okay? Markets could be overvalued and might be overvalued for the last few years. Nevertheless, the financials, this entire last year, and I have been short the XLF specifically over the last year. It's down over 4% year to date. I don't mind showing you guys this, but my position over here, I am short 7,100 shares of the financials over there. So make no two ways about it. It is my largest position. And the financials right now, they're threatening to break back down. So I'm going to watch those with bated breath. But let's move onward and upward, because I don't want to focus on individual. Okay, I want to make this clear. I don't want to focus so much on individual stocks right now. You got to start looking at the market as a whole, and not just what's going on just in the S&Ps over here, but the market as a whole. The S&Ps, okay, the relationship to volatility. What are the bonds doing out there? Because I want to try to give you a read of what to expect, not just in the here and now, okay, but trying to expect, risk to the future. And one of the things that we're going to look at, very, very frequently. So we'll be doing a couple of videos per week over here. And one thing you're going to get used to me looking at is things like expected move. Like, recognize that over the next 2 days, the S&Ps, they're only pricing in plus or minus a $20.50 move. There's nothing on this screen, nothing at all on the screen that tells you which way, per se, those S&Ps are going to go. But if we start looking at one product versus another product, and really these products in conjunction with one another, you can start to get a much better feel, okay, for markets. However, here we are at the end of the year. There's no rhyme or reason for markets moving right now. We're doing, only about, between 40 to 50% of normal volume in the market. That's why I say predictability gets thrown out the window. Nevertheless, we're looking at a $20 expected move. However, you start to go out to the beginning of the year and you'll see volatilities pick up from 13.75%. You start to see volatilities of some 17%. But here's the point that I really wanted to make with this. And this is kind of what I want to drive home and you thinking about over the next week or so. The IV percentile in the SPX is only at 23. That's actually really low ranking. So what that means, is that implied volatility not only has been considerably higher, but implied volatility can have an extreme measure above and beyond where it currently is. Now, when I looked over at a chart, and again, I'm not the big market technician here, I don't know about you, but granted, back here in August, this was volatile, right? This looks to me, in the last 3 weeks of trading, to be rather volatile. But then I keep reminding myself and going back over here to implied volatility. I'm like, does the implied volatility just not get it? Somebody needs to kick this thing and wake it up. All right, the implied volatility is like 17%, or if you want to look at the VIX, the VIX, it's the fear index. It's at 17%. Okay, it's like next to nothing, and the VIX is looking 30 days out at volatility. And it's kind of surprising to see volatility that low. However, I go over to the chart and I look at this and I go, wow, this looks volatile. So I brought up a couple of studies over here. I'm going to go add study down to volatility study. I'm actually going to bring up historical volatility. And this is the annualized standard deviation of the past stock price movement. I just want you to see it's on the rise. Okay, so the actual stock price movement is on the rise over here. And then when you start to compare that, we'll go to study, we'll go add study, and we'll go volatility studies. Now we're going to bring up implied volatility. Okay. The one thing that I learned from looking at this, I'm not looking to say, well, let's compare implied volatility, historical volatility. I just want you to see that if we zoom in here, the implied volatility is actually dropping, but actual movement inside markets is increasing. But you got to remember, implied volatility, it's a forward-looking registration of volatility. It is sitting at about 17%. Then you get actual stock price movement, it's sitting about 18%. Okay? What I find interesting is that implied volatility is kind of dumping off. Historical volatility is screaming like we're moving. And we're moving quite considerably right now. Yet again, implied volatility seems to ignore that. So where does it leave me? It leaves me in the position not wanting to sell options, okay, at least for the time being, specific to the SPX and index products. Okay, that's why I'm bringing this up. It leads me to believe, and there's a number of other factors that I'm bringing into play over here that I'll cover over the next few days, but it leads me to believe that why would I want to sell options premium when in a situation like this, in the next few weeks, like it can't really go that much lower. Like implied volatility, it's really, really low. But actual movement of the S&P is saying otherwise. So why would I want to sell options premium and sell myself into one of the lowest implied volatility? I mean, you got to look at implied volatility. It's a market. It's a market. And when the market is really, really low, okay, do you want to sell the bottom of a market? No, because the only place it can go from there is up. And yet actual movement in the marketplace is, okay, on the uptrend over there. And that's what I'm trying to kind of reiterate in this particular case is that, again, if you're a directional trader, everybody's trying to figure out X, Y, Z. Is it going up? Is it going down? Oh my, I don't know. Okay. Again, where chop trade, low volume, low liquidity becomes that much more unpredictable. The area that you can take a stance and say like, hey, maybe I don't want to sell premium. Hopefully you sold premium, okay, 2-3 weeks ago when volatility really started to pick back up and was kind of kicking in. But right now, just sit back and kind of see what we're looking at to the first of the year. And over the next couple of days, I'm going to do a number of different videos that are just going to bring you up to speed, a little bit about TheoTrade and so forth, and kind of introduce you guys to TheoTrade. But again, I want you to get into the driver's seat, start thinking about premium selling, because I'm going to tell you right now, 2016 is going to be a premium seller's paradise. Thanks a lot. This is Don Kaufman over at TheoTrade. Join us tomorrow. Bye-bye.